Hello. I hope you guys have a very good weekend, yeah? A few days ago, the US elections is making the market very crazily. The Trump wins the game, and then the the DJT goes goes on crazily, and the option is reaching a very high IV value. If I'm not mistaken, I checked it yesterday, it was like 160% in the implied volatility, which means the market is actually expecting that the DJT will going to move for 160% in the following years, which I don't think is a reasonable IV. So it will be very dangerous to get into call options positions and put option positions. But if you are just going to sell the option instead, you might do so. Because the higher the implied volatility, the higher the premium that you will get. It might be a very good timing for a short, for a sell, but just be aware of where are you going to set the strike price and also the expiration date. Let me check for a bit. Yeah, the line is very broken. And you might hear that my sound get a little bit shivering because the temperature here is very cold. I think outside is actually raining right now. I got very freaking cold head. So wait, no more. Let's start on today's sessions. So let me introduce myself first for those who come in for the first time. My name is Junlo, and you can call me Jay or you can call me He 老师. Whatever you want is all up to you. And if you can feel free to contact me since I will just leave my contact at the end of the sessions, and then you can just contact me through WeChat or WhatsApp. Then I will answer all of your questions. Then let me have a little bit brief background on my own. I have a 4 years experience in the fund management and 2 years specialized in 2 years specialized in quantitative analysis, which is I do the fund trading. I build my own algo custom board to help me to generate some revenue while I'm falling asleep. So yeah, it made quite a good return for the past few years. The annual return will be around 26 to 33%, if I'm not mistaken, and the absolute drawdown will be 6%. And now I'm the senior financial analysis for USmart, and I'm going to give you 3 classes for every week. And we will talk on how to get rich, how to accumulate wealth, talk on the financial market, and also some tools that are able to utilize to make some money. And in these sessions, I'm not going to sell you any courses. I'm not going to upsell you. And then I will not going to collect any of your informations, your email, your phone number, and even your money. So if someone come and approach you to get your money and all of those information, please be careful, yeah. It will not be me, but someone who using my name. And let's talk on today's classes. Today's classes will be AI insight and strategy enhancement. I come up with this idea because I'm wondering if AI able to help us to make a trading strategy that helps us to make some very great revenue in the market. So I come and ask for ChatGPT help. I asked ChatGPT whether it can help me to flip 1,000 to 10,000 in a short period of time, and what will be the tools that he recommend, and then how to build a complete strategy to it. But after a few discussion with the ChatGPT, I found out that AI itself is actually very difficult to just give me a very good strategy, a complete strategy instead. So I'm actually using my own opinion and my own analysis to just complete the AI insights and then make a complete strategy enhancement. And I think I will going to just deposit some money and then to try out if this strategy works. If this strategy is going to work, I will just maybe post my results somewhere, and then I might be the first case who prove that AI actually able to help us to make money in the financial market. Because I do search around and then I didn't find any proven result that AI able to help people to make some wealth. So this is the result that I found. Is there any verified successful investment or trading story? When I look for it, it shows nothing. None of the results show that AI actually have a verified result. And then most of the successful trader and investor usually you have their own opinions and then they don't depends on AI. But there is some successful story with the help of AI, but not in investment and trading. So the first case will be the healthcare, which is Dr. Eric Bobo. Let me check on my little script, yeah, because I'm not very familiar with his story. So he's a cardiologist, a doctor who leverage AI in the healthcare to enhance patient diagnosis and also personalized treatment. So basically, he's just using the AI to just have a faster, a more efficient way to diagnose the patients and then give them a personalized treatment completely built by the AI. But it's only giving the suggestion, but not the surgery and all those things. So it's actually helping to help the healthcare to lower down the burden, of the doctor. And then the second case will be music. The Amber Music is an app built by Drew Silverstein, and then he formed this AI-based platform to create the custom music. So he analyzed the very big amount of music data, and then he helped the creator to compose and produce the original music within minutes. So he have a database full with any type of the music, and then he can just help us to create a original music by our own within minutes. And then it will help you in social media, advertisement, films, and so on. And then the last one will be the apps, Be My Eyes apps by Hans Jorgen Wiberg. And then this app is actually a life-changing app that connects the visually impaired people who have a volunteer to have a sight impact. So the volunteer can use this app to help those blind people to assist those blind people with some real-time tasks like readings and all those. So actually, those volunteers will be the eyes of those blind people through this app. So, and then here come my questions with ChatGPT. First of all, I asked GPT when I want to put $1,000 into options, how do I make profit from it? But ChatGPT is giving me a very general answer, which ChatGPT say I need to have some study on the tools, I need to have some risk management, and I need to read some books, I need to be prepared of myself, do my own diligence and all those. So I found out that if I'm asking a very general questions, ChatGPT might not be able to help me in those. So I become more specifics in those details. Now I'm going to ask the ChatGPT by by just giving my goal first. First of all, my goal is I want to flip $1,000 into a $10,000 within a short period of time. But my focus will be safety and a high win rate instead of a very crazy profit. I want to be safe first. I want to keep my $1,000 safe. Then I only talk about money. So this is my preference. And then what will be the strategy that ChatGPT will be advised? First of all, I just wonder that what is the underlying asset that is going to choose? And what will be the filter to choose all those assets? There's a million assets in the market. So how do you choose among all of those? And then when you choose the asset, you choose the diamond among it, what option strategy are you going to use? In what circumstances? And what is the option expiry date? How do you choose an option? The expiration date, the strike price, and then how do you get in? The timing for your entry and also your exit. And then how is your trade management for every different scenario? Like once you get in, it goes up, or it stays stable, or comes down. You need a very complete strategy to just before you get into the market so that you can be prepared for every conditions. This is how you going to make a complete strategy. So if you follow me step by step, I'm just going to show you how do you enhance a strategy and then how do you complete a strategy and put it into use. And then this is the answer that ChatGPT tell me. Because I say that I want the safety first and also the high win rate, prioritize the high win rate over the instant profit so that he want to focus on minimizing the risk and then target on consistent gain. And then here become the detail. First of all, what underlying asset he suggests me to choose? He suggests me to focus on high capital ETF like SPY and QQQ instead of individual stock. And this is the reason that he provide. I think I didn't put it in, and it's okay because I do remember it. Okay, so he suggests me to focus on high cap ETF instead of individual stock is because of the liquidity and the volatility. Because the high cap ETF like SPF and QQQ are usually highly liquid. So you can get in and get out without any slippage, without any problem. When you are using option in some specific stock, you might find it is very difficult to get up or get into the positions because when you want to buy, nobody want to sell you at specific strike price. And the slippage might be big. The difference between the bid and ask might cost you a certain percentage of profit. So this is the cons of investing and trading options for individual stock. But if you are using those high cap ETF, it is highly liquid so that it won't be any questions for you to get in and get out. This is the first problem, liquidity. And then the second is those ETF usually have a very high market representative. The SPY represent the S&P 500 and the QQQ track the Nasdaq 100. It reflecting a very broad market instead of just some specific trade, some specific stock, so that it lower down the risk that it will bring down, it will just like a falling knife dropping down due to some specific single stock risk. So this is the benefit of trading a very high capital ETF. First of all, you get the liquidity, get in and get out without any problem. Second, you'll be more stable when you compare to individual stock. That one, when those individual stock have some problem, encounter some problem, and is dropping like a falling knife, but those high cap ETF won't be affected by it. Maybe just a little bit, but not that much. And what will be the scenario for you to choose those ETF? There's a lot of ETF out there. So what will be the criteria for you to choose among all those ETF? First of all, you need to have a moderate IV, not too low, not too high. And second, you need to have a very stable price movement. Like SPY usually just go up for decades. When you scroll up from the chart itself, you can see that SPY are in uptrend, in a very clear uptrend. It's just a matter that how long does it take to climb the ladders. When we are going to choose a moderate implied volatility, it is because that a high volatility means higher risk. We don't want that because we want a safety and higher win rate instead. So we want a moderate implied volatility instead. And then when we already have the target as set to choose, now we are going to look for the strategy. And this is the strategy that ChatGPT suggests me. First of all, it suggests two different strategies for different scenarios. The first one is the bull call spread, and the second is the short-term iron condor. And then it counter for different market scenario. I'll go into the real case study in a while, so bear with me. So what is the bull cap spread used for? It's used for a very clear uptrend, and when there is a pullback, it might be a very good timing to get in to just continue the rally. And then how do you choose the options? It suggests me to choose an option with 1 to 2 months out. So it allowed me to have a faster gain, a quicker gain while leaving the room for the market adjustment. We don't want to do for options that expire within weeks because the data is too high. And then once you get out, the market don't have the room to breathe. So 1 to 2 months out will be a very suitable area because when we are choosing closer, the first thing is the premium won't be that expensive. The second is we can see the result very quickly. So when we are going to do a bull call spread, we need to buy the call with the strike price below the current market price. And then we sell a call with the strike price above the current market price. And the position size that it suggests me is 1 to 2 contract. So I can just keep my exposure. I keep my limited total risk at 20% of my capital, because initially we talk about capital of 1,000, right? So with 1 to 2 contract, usually we can contract within 200s. I will show you the example later on, which is a real life example. So this is how are you going to build out a bull call spread. First of all, we look for the SPY. We look for SPY, and the first one will be the SPY. And then this is the interface when we when we click on the SPY. And you can double check on the top and also the top right corner for the name. So this is indeed the SPY S&P 500 EPF. And then we will need to look for the options. When we click for the options, we will go to more so that we can expose to all the possible positions. And then you can see that this will be all the available options that we can choose. And then the ChatGPT do suggest me with an expiration date of 1 to 2 months out. So in this case, I will just going to choose 2 months out. I choose the maximum. So 2 months until from now on will be 2025, January 17. Okay, then we go into the options. First of all, we check on the options expiration date, which is 2 months out from now. And then we need to check on the liquidity. The volume it represents the liquidity. This is the volume of the trading amount. So you can see that there will be a very high amount of trading amounts just across every pricing, no matter you are doing a call options or put option. So once you check on the liquidity, this this option is a very ideal options for you to get in and get out. So it won't be any problem if you want to get out and there will be no seller or buyer. You won't face that questions. So how are we going to do a bull call spread? When we are going to do a bull call spread, the first thing is we buy a call options, because we are targeting for bull, right? So we go for call options instead of put options. So we buy a call option with the strike price below the current market price. The current market price is falling on 591. And then in this case, we are going to choose 586. When we buy these call options, we need to sell another higher strike price call options. This is how it works, because usually when you buy one contract itself, it represents 100 shares. So if I'm just going to buy the call option alone, then the premium that I need to pay in this case will be 19.33 times 100, which is 1,933. But our capital only have 1,000. We don't have that much of capital to just buy this one contract. That's why we are doing a bull call spread instead. We're doing this bull call spread to just collect the premium from the selling positions to cover the premium that we need to pay. So this will be the two positions that we going to look for. The first one is we buy a call option with a strike price below the current market price. The current market price is 591. So we buy it on 586. And then the premium that we need to pay will be 1,933. Then we sell a call option with a higher strike price. And we will collect 1,326. In this case, the net premium that we pay is 607. Now I will just show you how to do the calculation for the potential profit. The potential profit itself is very easy actually. First of all, you need to know what is the difference between those two options that you choose, because you are actually able to execute the first call options. So whatever price that above 586 will be your profit zone. And then you do another sell on 596, so that the area above 596 will be offset. Now the profit will be only limited to the area in between these two options. So you use the higher strike price to minus the lower strike price. Now you get 10. This $10 range is actually the area that you can profit. Whatever that is higher than 596, it's actually go to zero, offset with the profit of the buy the call options. So this $10 profit zone minus the premium that you pay for this strategy, which is $6.07 for each share, will be $3.93 profit. So this profit, and then one option equal to 100 shares. So this will be the potential profit of your strategy. You might see that this is a very bad risk to reward ratio, because you are risking $1 for 64 cents returns. You are risking $607 to just try to fight for $393. But there's actually a way to adjust this strategy, to adjust this risk and reward ratio, which is we can do it by closer up the gate. Now we are going to buy options with a closer strike price, and also sell an option with a closer strike price to the current market price. In compared to the previous, we go from the $10 range into a $4 range. So that in this case, let's do the calculation together again. So when I go into a call option positions, I need to pay this kind of amount for the premium. But I don't have that much of money. My capital is only limited on 1,000. So I go into another selling position, which I get the premium. When I get the premium, I'm able to cover the premium that I pay for the buy positions. So now this is the total premium that I need to pay, which is very reasonable for our cases because previously we say for 1 to 2 contract and to limit the total risk into 200 capital, $200 for every trade. In this case, we successfully to just manage our trade and then limit our losses to 207, which is around 20% of our capital. It have leave us a higher room for the error. And then the potential profit will be this one will be a $4 range. Using the highest strike price to minus the lowest strike price, here we get the $4 range, and then we need to deduct the premium pay for this strategy, which is $2.07. And then this will be our profit. And here you go, we able to generate a higher risk to reward ratio. This is closer to 1 to 1. In some cases, it might be greater than 1. It depends. So I often see a lot of bull call spread that is able to provide a higher than 1 risk to reward ratio. So you might need to look for a better options to get into, or you can just play around between the game. So this one will be better when comparing to the previous one. Okay, so for the second option strategy, it's suggesting me to do a short-term iron condor. The iron condor is actually well known for a very low volatility market, so it allows us to just gain from the sideways price action. When the price is trapped between a range where there's a very clean and defined support and resistance, and the price keep on trapping in the range, this will be a very perfect strategy to just make some money. So this is how are we going to select for the options. First of all, the expiration date, still the same reason, 1 to 2 months out. So enable time for us to just monitor, and then we can have some potential adjustment on the position itself, and also allow the room for the market to breathe, allow the room for the market to just move around, and then yeah. And then the second is, how are we going to select the strike price? When we are doing an iron condor, we actually doing a selling position out the money, just away from the current share price, and then we need to cover the losses by buying another further out the money positions. I will show how are we going to do it later on. And I found this strategy to be more interesting when comparing to the bull call spread. The risk to reward ratio is crazy, I'll tell you. When I do the mathematics, I also cannot believe it. Okay, so it's suggesting a position size of 2 to 3 contract, and I will tell you why. It's because iron condor is a very relative low cost strategy, and you can see from the calculation behind. This is relatively low cost when comparing to the other strategy, so you can get into more positions. And this is the same interface as just now. I'm still choosing the same options, which is 2025 January 17th. And then how are we going to do an iron condor? First of all, we do a selling first, because the iron condor is actually aiming to get the premium instead of catching the trend. So we do a sell put. We do a sell put at 587, and then we do another sell call at 595. And then we want to limit the risk. So we buy another further out the money in this case. And I will just show you in the graph, because this thing itself, this list itself is very frustrating in reading. Okay, now these 4 will be the total our positions. I'm going to show you why are we doing this. First of all, we are doing a selling in a closer out the money positions. In this way, we are doing a selling at 595 and another selling for 590 and 87. The above one is sell call. The below one is sell put. And then when you go beyond the zone, we are actually at the risk. So we want to have another buy position to just limit the risk. And here will be the premium that we pay. First of all, we do the selling position. So this is the premium that we will collect, which is 1,379 for the sell call and also 1,000 something, 1,067 for the sell put. And then we need to pay for the premium to just cover the to just limit our risks. So in this case, this will be the total premium that we pay. And you can find out that when we net off, we actually have a profit of 188. And this is the premium that we get from the strategy. This 188 is also our maximum profit. So now we want to check on our risks. So by using this strategy, we are not paying the premium, but we receive the premium instead. Okay, now let's see. If the price is ranging in the zone, which is what we expected, we actually expecting this to happen so that all of the position go to expire. And now it won't be any P&L from all those positions because all those are getting expired. So the net P&L will be 188. But what if it goes beyond? In this case, it goes up and then the position below will be expired. And then the position above will have a $200 losses because the losses will be kept within the range 597 minus 595. And the area above 597 is actually offset with the losses occur by 595 sell call. So the maximum losses that you're able to get to happen is $200. So in this case, you have a losses of $12, just $12. Previously, you get 188, and then the losses that might occur is $12. Now you can see the crazy risk to reward ratio. And what if it doesn't go up and comes down instead? If it comes down, this will be the case. Still the same calculations, whatever zone that duplicated will be offset. So we only calculate for the difference in between the strike price. So in this case, the difference between the strike price will be 200. And all the call options above will go into expired and have zero value. And there will be no P&L. And then for the maximum losses that you will have will be just 200 losses. So in this case, you will also have a $12 losses. So now you can see that the three scenario already illustrate, and the maximum losses that you will be able to have is $12. Meanwhile, the maximum profit that you are able to gain is 188. And this is a very crazy 15.67 risk to reward ratio, which means you are using $1 to make $15. This is actually crazy. And you do remember that previously we said we can get into 2 to 3 position is because you can see the maximum losses here is actually the cost that you need to bear. So this $12 itself is your cost. That's why I say that it is a very relative low cost strategy. So now we already talked about how these two strategy works, and we want to talk about the entry and exit. what is the entry and the exit for us to just execute all those positions. So it suggests, the ChatGPT suggests me to do a bull call spread when the SPY and QQQ is bullish, and also the VIX is rising. Because when the VIX is rising, the bull call spread is actually a buying position. When you're comparing to the iron condor is a selling position. The bull call spread want to catch the trend, while the iron condor is actually making profit from the premium, but not the trend. So you do need to remember, if there's a trend, if it is bullish and trending, and the volatility is increasing, we actually want to profit from a buying position. And in the vice versa, we need to do the iron condor. So for the strategy B, the short-term iron condor, we want to do it only when SPY and QQQ is in a low volume and the volatility is, the fear index is below 15. And I will just show you the scenario. This is the VIX index that you are able to find on Usmart or anywhere. And you can see during May to July, the VIX actually is kept below 15. So it's just ranging below 10 to 15. In this case, we want to do the iron condor because there's not much volatility in the market. So we want to just catch the premium and then just allow the chart to play within the range. Because when the volatility is low, it's very unlikely for the index to just have some crazy movement. And then we will have another sessions where there will be very crazy VIX. In this case, we want to keep our hand clean, which is no trade zone. In this kind of event, we want to keep ourselves clean. No matter we are doing because the first one, when we are doing a buying position, the bull call spread, we want to avoid paying a very high premium. But when the volatility is insanely high, it also increases the premium that we pay. So in this case, we won't do the bull call spread. We won't get into a buying position because of the high premium. And the second case, we are not going to get into an iron condor because when there is volatility, there is movement. The price is not kept within the ranging zone, so we are not going to do a short iron condor. Maybe another short position will be performing well, but not the iron condor. Okay, so now, which is the zone that I'm referring now, is actually playing with within 25 to 15 to 25. And you can see it's dropping crazily yesterday, and it dropped to 15 right now. So in this kind of zone, we're actually expecting to do a bull call spread. As you can see, during this time, the market is in a very bullish rally. So no matter what is the stock that you are doing, you actually can catch the trend, the bull trend. So it's also proven by the SPY is also in the uptrend right now. So when we're able to identify what strategy to use in this case, now we want to know what type of trade that are we going to take. Are we going to do a day trade or a swing trade? There will be different pros and cons. So it depends on your personalities. So for swing trade, because previously I say that my preference itself is safety and high win rate. So these two are actually the characteristic of swing trades. Because when we are doing a swing trade, which means that we are holding the position for several days to weeks, we are not going to exit the position within a day. So when you're comparing to the day trading, the swing trading it usually make it very easy to analyze the market trend. because you are not going into the minute chart. You're just going to check on the hour chart will do. And then it will have a lower transaction cost because the trade that you take is lesser. So in this case, the transaction cost is also lesser. The day trading usually involves a very high frequency of operations, which will make you a very high transaction fees. And then for the swing trade, we also have the advantage in time because we hold it for slightly longer. So the market can actually play off the way that we want. We have a little bit more room of error for those the underlying assets to play off. So instead of just targeting it to achieve a certain level within a day, giving it some day to breathe will be better. But there will be also a cons for it because we are holding it for overnight. So in this case, you might not be able to get sleep very easily and very comfortably. So it depends on your personality. So make sure that you don't get into a position that is way too big and make you feel very comfortable to get into your sleep. And the second is your position get to lock on because you are holding it for several days. So when you see another better opportunity, you might not be able to get in. Okay, so here comes then we will just talk on what is the benefit of day trading. Day trading itself actually enable us to have a very quick gain, which I usually do the day trading in my previous year because I'm doing it for fund management. And then I used to do it and then I get to have some profit funding. And then day trading is actually have a very short cycle and then you need to have a higher frequency of trading but you can see the money real quick. It's just that you need to have a very high level of intuitions, very high level of focus when you are doing the things. You need to manage your psychology very well instead of the swing trade. But the benefit is you don't hold position overnight, which means you can sleep very well if you don't make a losses at the day. I guess some people might not be able to let it go when they have some losses. So yeah, but for our cases, which we want to flip $1,000 to a $10,000, I would the ChatGPT actually recommend me to do swing trading instead because I say my preference is actually lower risk and higher win rate. So swing trading might be a better choice, might be. So the swing trading will allow me to capture the trend more effectively. So all those strategy that I use is for options that is going to expire 1 to 2 months, right? So swing trade won't be a problem. The second is my time management will be better because I can avoid a very high frequency monitoring. I can just check on the chart once a day and then I make my decisions. I can just place the trade and then let it go. Let it do the things, let it do the calculation. So, but if you have a very high focus and available time, you might consider to do day trading. Maybe start with a smaller portion first. And then if you are very talented in it, you might consider to just focus on day trade comparing to swing trade. But for me, myself, I actually won't do the day trading. Yeah, I will choose swing trading instead. And now we wonder what chart do we need to look for. The first one is the ETF chart, which is the underlying asset. And the second is the option chart. I wonder if people do watch the option chart to trade or not, because okay, here come the comparison of those charts. The first one is the chart of SPY, the ETF, and the second is actually the chart for the options. And you can see it runs differently. When SPY, the S&P 500, is actually rising very steadily, but the option is like ranging in the zone and then blasting at the last moment. But you can also see that there is a difference in the gain. The last rally, you can see that S&P 500 actually have a 4.78% gain. But if you are going for the option, that will be 159% rise. So this is the power of option. So when you already check on the chart of the S&P 500, and then you decided to get into the position, you can choose to get into an option position instead to just enjoy the benefit of the leverage. And you can see the difference in between the profit is very big. And the different, why I will just explain a little bit why the chart look different is because there's a great value in the options, the delta, the vega, theta, and gamma. So if you do listen to the previous class, or you can just check on the record, the recap, and the all those three value actually affecting the option premium price. So it's just not as simple as up and down. When we are talking about up and down in the share price, there also be another factor like time value and also the others acceleration factors that affecting the chart of the option price. So it's very hard to predict the chart where the option price is going to head off. So to just make things simple, I personally would recommend to just check on the S&P 500 chart. So now we are going to talk on time frame. Now we already have the method that we are going to trade. We are going to do a swing trade, and then we have our strategy. We know when to get in. We check on the VIX to know whether we want to execute the strategy A or the strategy B, the bull call spread or the iron condor. Now we need to know how to read the chart. So to get into the position, just like just now, you read the chart of the S&P 500 so that you can able to catch the bottom. You need to know when to get in, okay? So I will personally, because we are doing it in the swing trade method. So first of all, we need to check for the daily chart because personally, I will recommend to use daily chart, 4-hour chart, and hours chart. These three will do. When these three sync in the directions, you are very good in deciding, you will be good in deciding the direction. When these three sync, then the direction is very clear. First of all, we use the daily chart to just, but if you are going to do a day trade, you can just check on the lower time frame, like 30 minutes, 50 minutes, 5 minutes, 1 minute. Those will be for the daily, the day trading style. But we are doing it in the swing trading style. So first of all, we check on the daily time frame first. For the daily time frame, it's actually to identify the direction. This is the indicator that I use for clearer illustrations. So it's very clear that we are in the uptrend. Okay, now we already know that we are in an uptrend. Then we need to know when are we going to check on the options and get into option positions. In this case, it is in an uptrend, and then the VIX is above 15. So we are going to use strategy A. Strategy A, which is the bull call spread. So we want to get into the bottom, and then we sell at the top. So this is the method that I use. Usually I will just check on the position allocation. So you can see that most of the funds are actually allocated at this area. This is one of the indicators that we can find in the trading view. And if you want more support in how to read those, we will have another session of going to the deep in to the technical analysis. But I will just briefly introduce the way that I trade now. First of all, I check on the direction, and then when we go into the 4 hours, we can actually use it to identify the support and resistance. And the best indicator I found by myself, which is more suitable for me, is actually the fund allocations. And we can find that all those trading is actually occurs within this zone. So this is the potential support and resistance zone. And you can see it become a resistance previously, and then it become a support, but the price unable to retrace until that level. It might be close, but it just didn't reach. So this is a very so we will just look into the following. After that, we find that the next area for the price allocation is this area. And you can see it from the blue line, the vertical line, that actually you can see that there's a retracement back to the area of interest where most of the funds are located. So this is actually testing on the previous zone of 571. And this time when you get into the option, you are able to get the profit of 159 just now that I mentioned. So this is the area that you can get in. You can pay attention to, and then probably to get into an option position to have some rally. Next on is what's happening right now. This is the latest fund allocation, and you can find that the latest fund allocations, most of the fund are actually allocating around 583. So we now are going to a 1 hour chart and wait for the price to reaction on and check on the reaction of price onto that level. And this is the 1 hour chart. And we can see that the price is actually high up now, and then we will need to wait it and then and check on the reaction when it come back to this area. If it come back to this area and form a bottom like the previous double bottom patterns, or there's a shift of structure when it come down to this area, you might consider to get into another option position. Or you can just build the bull call spread, which is very high, have a very high winning rate when comparing to the other strategy in this way, because you are actually trading with the trend. You befriend with the trend. Okay, this is a little bit sign that a little bit strategy that I use to build the iron condor. First of all, I open up the chart, the daily chart, and then I put on the average true range of 30 days. And you can see the average true range is measured that in the past 30 days, how many movement of the past 30 days can move. So you can see this 6.25 is representing that in the past 30 days, it actually moved a $6.25 that way. So okay. So I will just so when I know that in the past 30 days, the average move $6 move. So when I want to build my own iron condor, the best idea is the price kept within the range. So now the range is $6 movement. So to be safe, I will just put a $2 buffer. So for the case just now, the price is currently allocating at 591, and when I do the iron condor, I will just give it a $8 range instead of a $6 range, so that I can have a $1 range at each side, and then to make sure that the price will float around this area within the next month, within the following month. It will be a higher we have a higher probability that to just cap within this range in the following month. But now it's not the correct timing for an iron condor because first of all, SPY is in uptrend. It's not ranging. I'm just showing you how I make the iron condor, but now it's not the right timing because SPY is riling up and then the VIX is above 15. The precondition does not fulfill. So I'll just introduce you the method and how to do when the times has come. Okay, so this is how you do the strategy A, bull call spread, and also the strategy B, which is the iron condor. So we already enhanced the strategy provided by the ChatGPT because ChatGPT just give me a very little hints, which is the strategy itself, and I need to make use of it by myself, and also I need to identify the timing of get in and get out, and then also need to complete it by what is the timing that I'm going to, what is the type of trade that I'm going to take, which is in this scenario, I will going to do a swing trade. So for summary, I will just for now, when I prepare a fund, first of all, I'm going to check the VIX. So when the VIX is above 15, I'm going to go with strategy A. Or the strategy is below 15, I'm going to go with strategy B. Second, when I already know what strategy to use, I need to identify the timing for my entry. I need to catch the bottom for strategy A, and I need to know the range to set for strategy B. So I'll just check one by one from the 1 hour, the daily chart to check on the trend. If this is on an uptrend, then strategy A is better. If this is ranging, then strategy B is better. So you need to synchro in both precondition. And once I check the daily trend, I go to the 4 hour for the area of consolidations and also the support and resistance. Next, I go to the 1 hour to just check on the reaction of the price, the candle at that level. So it will be easier for me to just get in when the reaction of 1 hour occurs, so I can get in on the earliest entry, and then I can just take the profit at the daily chart. Okay, the last one is the execution in options. When I check everything and everything is synchro, I can just go to the options and then I choose an option with 1 to 2 months out expiration date, and then I will just pick the correct options, the correct strike price, and then I will just make sure that the risk to reward ratio is worth it, is better, and then I can just when it come, and I also need to do a risk management because in the first case, the risk that we are going to risk is 607 to get a $393. And that is not a correct strategy to use because you only have $1,000 in your pocket and then you are going to risk 60% of it in one trade, which is crazy. So make sure that when you build out the strategy and then you choose the correct options, you need to limit your losses into 20% of that position. Because in this case, we only able to limit it into 20% of the capital because option is costly. But if you are going to do, if you have a higher capital comparing to 1,000, I would suggest you to use a smaller percentage of losses in your total capital because 20% to me is still a little bit too high. So this is what I have discussed with ChatGPT, and I found that it might not be a bad strategy to use. And previously, I didn't use this kind of strategy in my own portfolio. So I might consider to put in some money to just verify if this work or not. Then if this strategy is work, then we might have some other section to just share the result, but not recently because we need time for the result to run. So this is the end of the sections. And here comes the content that I'm going to share. And just share a little bit insight on what is going to share on the next week classes. In the next week classes, if I'm not mistaken, one of the lecturer are going to give a briefing on different method of analysis, which might be fundamental analysis, technical analysis, and my and for myself, I'm going to talk on the different type of method to profit in the option market. The first one is the rocket money. And then the second one is the steadily accumulations. Okay, here come my contact. If you want to contact me, feel free to contact me. And if you have any question they want to ask regarding the financial market, and not only limited to options, you can feel free to contact me. Or if there's any topic that you're interested and you want to arrange it into the schedule, you can also raise it to me. Then I will try to arrange the topic that you're interested into the schedule as soon as possible. So at last, let me share you the benefit of opening a USmart account. If you open a USmart account right now, you're actually able to get a Tesla share. And if you deposit more, the more cash voucher that you will get. And here will be the registration QR. If you are not a user for now, and then you feel you are interested to just open an account and start your trading journal. Okay, so here comes the end of our sessions. If you guys have any question, feel free to raise, yeah. Else we'll just end these sessions right away. And last, I will just share the disclaimer. So when you are doing any trade, make sure to do your own due diligence. Okay, you're welcome, Evan. Happy weekend. Hope you enjoy your Fridays. And hope to see you guys on the next week. Okay, if there's no more question, that we are going to end our session right away. And thanks for your joining and appreciate for your time. Thank you.